Jennifer and Dave, make sure you're muted. Dave, make sure you're muted. Good afternoon and welcome to our webcast, Wealth Transfer, Safeguarding Your Assets in a Shifting Estate and Income Tax Landscape. For those of you who I've not met, I'm Dan Meyer, publisher of BizTimes Media. Thank you for attending today's webcast, which is presented by Annex Wealth Management and Reinhard Berner Van Dieren, and powered by BT360 Content Solutions, the storytelling arm of BizTimes Media. How will the 2020 election results affect your estate and wealth transfer planning? Sweeping changes originating from the White House or Senate could dramatically alter the existing income and transfer tax landscape. With likely changes on the horizon and the opportunity to transfer wealth at depressed values and low interest rates, now is the time to reevaluate your planning. As high net worth business owners or investors, there are strategies you can employ right now to help you prepare for the transition that is coming. In today's webcast, our expert presenters will discuss and help you navigate your way through a variety of topics, including taking advantage of the current lifetime federal gift and estate tax exemptions, minimizing gift and estate taxes, preserving wealth for future generations, and planning for upcoming legislative uncertainty, and much more. The slide deck will be available after you fill out the attendee survey at the conclusion. Before we begin, however, on behalf of BizTimes Media, I'd like to thank you for your readership support and for your print and digital advertising support and event sponsorships, and for attending this webcast today. This is our 25th year as an independent, family-owned business, and we're the only locally owned business media company in the region. Our goal is to serve this community for 25 more years and I guarantee that we'll work hard every day to earn your business and to help you grow your business through our custom and integrated marketing programs. If you're interested, please contact our sales director, Linda Crawford. In addition, our award-winning editorial team is always looking for story ideas, especially forward-looking operational insight stories that can help our readers make more informed decisions in running their company or insights on how to be better leaders themselves. And recently, we launched an insider subscriber program. For $8 a month, you can be an insider and receive several insider benefits, including access to all the content produced by our editorial team. It's also your opportunity to support local journalism. Before I introduce the presenters, I want to mention that today's webcast is being recorded and will be available on demand on our website tomorrow. As I mentioned earlier, upon conclusion of the program, please fill out the attendee survey to access the slide deck. So now on to the presenters. They include Dave Spano. Dave is President and CEO of Annex Wealth Management. Dave, welcome. Please give a shout out to everybody.
Thank you, Dan. Appreciate you having us today.
Yeah, glad you're here. And Jennifer D'Amato, shareholder, Reinhard Berger Van Buren. Welcome, Jennifer.
Thanks, Dan. Glad to be here.
And welcome to you too. So during the presentations and discussion, please submit your questions, any questions that you might have on the Q&A feature on your screen. We encourage those and we'll get to those at the end. So now I'd like to turn it over to Dave Spano, President and CEO of Annex Wealth Management. Dave.
Yeah, thank you, Dan. I'm looking at my picture. I didn't know we submitted my high school picture, but compared to where we are today. So if we can start on slide one, and obviously today we're talking about wealth transfer and safeguarding your assets in a shifting estate and income tax landscape. And so I'm going to stick with the income tax and the wealth management side, and obviously defer to Jennifer D'Amato, who's a well-respected lawyer in the estate planning area. So we're going to break that up in two pieces. So let me just start with kind of an overview. In 2017, the Tax Cut and Jobs Act was passed, and that was a significant tax reduction across the board. Most notably, it lowered the corporate income tax from 35% to 21%. It took the top income tax bracket from 39.6 down to 37. And then there was this pass-through where you had a 20% deduction and effectively saving 20% of your pass-through income taxes. And so we're concerned that there may be a shift in tax policy. That, frankly, is going to come down to the runoffs in Georgia. I'm sure everyone knows where we stand, but as of right now, there are 50 votes with the Republicans and 48 with the Democrats. So there's two runoffs, both Republicans in the state of Georgia. Perdue is one of those races, and he is slightly up. The betting odds predicted has him at about a 75 to 80% chance of winning that, but we all know how polls have been over the last several election cycles. And then secondarily is Kelly Loeffler. She has a similar odd of winning. She's the Republican. And just Dave's fun fact for the day, she's married to a fellow named Jeff Sprecher. Jeff is born in Madison. He is a UW grad, and he's the CEO of ICE, which is the International Continental Exchange, and also the chairman of the New York Stock Exchange, and they are married. And so we happened to know Jeff. We're watching that race very carefully, because if the Republicans lose both those seats, the vice president would make the deciding vote. And so if the Democrats have the chair at 1600 Pennsylvania Avenue and the Congress all together, we would expect that rates would change. So having that as a background, I just wanted to tell you that we're not sure exactly where taxes are going to be, and that race is significant. So when we talk about wealth transfer, as you can see in slide one here, portfolio management needs to be tax efficient. And that could mean placement of assets. So should it be in tax deferred, tax free, how you hold those as in a non-qualified or qualified, those are very important decisions. And financial planning should be tax savvy, which means first to avoid the tax. Now, obviously there's the difference between avoidance and evasion. Evasion gets you a visit with a guy with a gold badge. And, we're not suggesting that you become Al Capone. We're saying tax avoidance, not tax evasion. So the first thing that you want to do is try to avoid the tax and then to defer it as long as you can. And if you can't defer it, then you want to pay as little as possible. And that is really an important piece because you've worked your entire lives to get these assets and you want to keep it. And that is a very important point. So Mary, the next slide, please. There you go, thank you. So what we're going to focus on here are those whom the politicians call wealthy, and those are people who earn more than $400,000 in income. And you have to remember that some of this stuff is event driven. So you may earn $400,000 or you may earn $150,000 and have an event driven circumstance. For example, you sold some stock options, you sold a part of your business, you inherited, whatever the case may be, your income might go up. And so the conversation that they're talking about is to move those taxes from 37 up to 39.6 on the top bracket. And remember, there's this tax lovingly called the Obamacare tax, which is an additional 3.8%. Which puts you at 43.5. Then you have to pay state income taxes on top of that as well. And state income taxes, we'll use 7.5 for the state of Wisconsin as an example, and that puts you at a 50% top marginal tax bracket. So it's certainly a significant amount of money that could go out the door. So you want to reverse and accelerate, reverse those and accelerate your income or deferred deductions in a normal year. So that means paying taxes as you go is very important. And then the second thing that's out there now is the benefit of itemized deductions. One of the things that the Democrats are talking about is to put the SALT back in so those who are paying property taxes could get some of that benefit. Now, we don't know that that is going to happen, but then that would suggest that you would pay your property taxes, all your property taxes after the first of the year versus before. Another idea would be to take those benefits is using what we call the bunching technique. In other words, because you could lose some of those deductions if you give to a nonprofit, you would take, for example, 2 years worth of donations and put them in 1 year. That's called bunching. And you can include what we write down here, DAFs, donor advised funds, instead of setting up your own foundation. Are all ideas to try to reduce your tax. Next slide, please. Tax planning for, again, staying with those who make over 400,000, remembering that it could be event driven. The OASDI is the Social Security tax, and today it's capped at approximately 139,000-ish. But they're talking about reinstating that for those who make more than 400,000. So there would be a donut hole between 139,000 and $400,000. So evaluating how you would get that income, the allocation between a salary and dividends and distributions would be very important. The benefit to saving in retirement is limited to 28%. That's part of the new plan. Today, whatever your tax bracket is the amount that you can defer, for example, and go and do a 401k or other type of qualified plan. Well, they're talking about putting that as a bracket up to 26 to 28%. So everybody would get a similar benefit, and we're watching that closely because it would reduce the benefit for those who are making a higher income, even those who aren't at 400,000, but who are making more than the 28% tax bracket. So again, and that's the ability to defer taxes by going into tax-advantaged vehicles. 401k plans obviously control trillions of dollars in our country, and would be something that you would have to pay attention to. But there's things that you might consider. For example, that Roths versus qualified plans. Roths are never taxed vehicles, right? You pay tax up front, and then that's it, and then you don't have to pay taxes. Versus 401k and IRA, you would get the deferral as it grows, but when you take it out, you have to pay income taxes on it. So, and one of the ideas that we use with and employ with our clients is to use Roths and Roth alternatives as well. Next slide, please. Then we move to tax plan for those who are over $1 million in income. And one of the things that has got a lot of attention is the fact that capital gains and dividends, which enjoy a benefit today. In fact, the top tax bracket for dividends and capital gains is 20% plus the 3.8% Obamacare. And they're talking about turning that into income and having capital gains taxed at that same amount. So instead of paying 20 plus 3.8%, you pay 39.6, effectively doubling the gain that you would pay on capital gain and dividends. And I think the thing that hasn't been thought out is, again, somebody who owns a dry cleaner and has spent their entire life earning and building their business, and now this is the year they try to sell it for whatever reason, any number of reasons, and then they have a major capital gain on the books. I think the politicians are thinking that you're $1 million in income person, that you're always going to be $1 million income person. And that is, I think that is a lack in thinking because we have a lot of clients who have events and they get a lot of money in 1 year for whatever reason. So traditional capital loss gain harvesting takes on a new twist because, business owners are trying to accelerate their dividends right now in some capital gains. In fact, yesterday morning, we saw that Costco is issuing a special dividend to the tune of $4 billion because they want to get that off their books and get it into the hands of their shareholders. We're probably going to see a lot of that. I remember back in 2012 when President Obama had won his second term and they were talking about increasing taxes. There was some 1,100 companies that issued a special dividend in that year. So pay attention to how that looks, and even in your own planning, should you accelerate some of those incomes and defer some of those deductions is key. And again, we talk a lot about this on our radio shows, but stay in your risk tolerance. And I can't tell you how many times people called the show or asked or text us a question that should I go to cash? Or should I try to time the markets? And of course, when you try to time the markets, you have to be right, not once, but twice, when to get out and when to get back in. And you can see this rally that we have had, and we still really don't know who the president is. I know that betting odds have it at 80% that Biden will be the president, but there's still some people who think that Trump has a chance. But again, we've had a heck of a rally here since knowing that. And that's the problem with trying to time the market. But remember, stay in your risk lane and rebalance as necessary. Volatility is going to be here. Next page, please. And I'm trying to stay on target. So if you think I'm going fast, remember that Dan will have these slides up for you. Tax planning for businesses is not always about taxes. I had a conversation with a client of ours who runs a publicly traded company, and I talked to him about the potential of 21 to 28%, and he made a salient point that it has less effect on him because he's not at the top marginal rate. He's paying his effective rate was more like 14 to 15%. So the marginal rate would go up and the effective rate would go up, but it's not like you have to take your net income and multiply it by 28%. So remember that tax planning is important, but it doesn't wag the tail of the dog. You just have to make sure that you're doing it being as tax efficient as you can. And then lastly, we want to talk about every business having a succession plan. If you don't have one, you're going to get one, and it could be that Father Peter knocks at your door one day. So you have to have a plan, and you should put it in place now, goals and objectives of the next family, if they're not there, they're lacking. And so if you do some planning now, solid estate planning and tax planning, there will be more to transfer and there will be less to pay to Uncle Sam. So secure it, and there's lots of ways that we can talk about. But installment sales is one way to do that. And that it is an attractive strategy, particularly as Dan pointed out in his opening remarks, that interest rates are low, and the Federal Reserve had said they're going to stay low till 2022 or 2023. Last slide, please. So the QPI benefit is might be lost for those who are over 400,000. That is called the qualified business income deduction. That's the one I referenced early on about a 20% reduction in taxes. So if you were at the 40%, effectively you're at about approximately a 30%. It was a significant benefit to those who owned real estate and small businesses. So there has been some conversation about people switching back from who went from S to C, back to C to S. I believe it's a 5-year hold, but there are people who are having that conversation. And lastly, bonus depreciation section 179 planning is one of those strategies that you would use when you're trying to accelerate deduction. So you may have to consider that. Sometimes corporations consider accelerating income versus deferring income, which is the traditional plan. And then the last slide, I should be right on time, Dan, is consider corporate minimum income tax on the books. This is ironically called GILTI, G-I-L-T-I. I think they thought they were being humorous, but that's the global tangible tax. And it's half of what the corporate tax is. So if the corporate tax is 21%, it would be half, or 10.5%. Is one thought. And then lastly, R&D credits should not be overlooked. And so
you've got a few more minutes. You've got a couple more slides.
Okay, all right, we'll go to the next slide.
Yeah.
Thank you, Dan. The CARES Act talks about something that's interesting, which is you can go backwards. If you had some expenses, for example, if you had a ton of expenses, you could go backwards into 2018 and 2019. You'd have to refile if you've already filed your taxes, but you could use those taxes. And remember that President Trump declared all 50 states a disaster area. So you'd have to amend your 2019 return to go back and do that. But if you've paid a significant amount of taxes in 2019 or 2018, you can go backwards and refile and maybe get a big check. And then I think we have one more, which is the PPP, which is affecting a lot of people. You'll remember that the PPP was out there if you filed for it, and there was a lot of money that was put out there, but it was abused by some companies. Remember the Los Angeles Lakers and some franchises that were national franchises filed for them and got them. But remember that if you did get that money, it may be forgiven and not taxable, but the expenses that you use to use that money for are not deductible. So make sure you're working with your tax planner to understand what's taxable and what is not taxable. And remember, there's accounting methods that, when did you take that income? And cash versus accrual is a very important part of that conversation. When you recognize the expenses and income are going to be impacted. So I know there was a lot of stuff that we covered here in 20 minutes, but we're going to have some questions at the end of the presentation that Jennifer and I will be able to handle. So thank you, Dan.
Thanks, Dave. Yeah, I'm gonna later. I'm gonna ask questions about the loss, past loss in the 50 states and the disaster areas. But
okay,
before I turn it over to Jennifer, if you have questions, make sure you send those in using the Q&A feature on your screen. So Jennifer, I'll turn it over to you now.
Terrific. Thank you. So I'm going to spend the next 20 minutes or so talking a little bit about, next slide, the shifting estate tax landscape. I guess in way of context, I would say I've been practicing in this area 30 years. And every time we think we have tax simplification, something changes. So once again, we're at one of those junctures where we're looking at what is the current law and what might be coming in the future. Next slide. So the current law says that every US citizen has an exemption from estate and gift tax. So it's a unified exemption, which right now is $10 million plus inflation. So that's 11.58 million for every US citizen in 2020. So a married couple has just over 23 million of exemption. And it's scheduled to be 11.7 million in 2021. So what that means is that is the amount that you can pass during lifetime or at death without paying any gift or estate tax. Now, there is an unlimited marital deduction, so you can leave an unlimited amount to a spouse, and it will be basically deferred until the second spouse's death. And there's also an unlimited charitable deduction, so if you leave a large amount to charity at death, you will not have to pay taxes on that. But any amount that you're leaving to your children, grandchildren, or other individuals other than the spouse are going to be subject to that exemption. And over and above that amount, there's going to be a 40% tax. So there's also something called the GST exemption, generation skipping transfer. That is basically a separate exemption. It's currently the same amount, 10 million plus inflation. And that amount needs to be layered on transfers that are left to skip persons, which are grandchildren or further generations, or individuals 37 and a half years younger than you are, or trusts for the benefit of those people. And that application of the GST exemption really is what allows us to do dynasty trusts and other multi-generational wealth transfer strategies. Current law says there is a step up in basis that occurs at death. So although there may be an estate tax, you will not have capital gains taxes triggered at death. And the beneficiaries, if they sell the assets when they receive them, would only have gains between date of death and the date of sale. Current law sunsets January 1st, 2026. And at that point, the exemptions revert to 5 million plus inflation. So basically get cut in half. So what you've got to do between now and then, or now and tax law changes, is one of two things. If you want to lock in exemption, either die, which is not the preferred approach, or do some planning to use your lifetime exemption. Next slide. So the possible Biden tax plan, as laid out in the campaign materials, basically talks about reducing the estate tax exemption to 5 million or even 3.5 million. There's language about going back to the 2009 tax law. That was a $3.5 million exemption, or 7 million per couple. So we'd be going from 23 million to 7 million. And the gift exemption might even be reduced below that amount. So you might have an estate exemption of 3.5, but the law might say you can only use 1 million of that during lifetime. We had a structure like that about 20 years ago. To put that in context a little bit, I mean, when I got out of law school in the late 80s, the exemption was 600,000, stayed that way for about a decade. Then we saw a law in 07 that went up to 1 million, 2 million, 3.5. 2010, there was no estate tax. And then we had the 5 million plus inflation, and then the recent tax act, which is 10 million plus inflation. So we've kind of been all over the board. We also see with the Biden tax plan possible further reduction of the GST exemption or a limiting of a dynasty trust duration. So we wouldn't be able to have a multi-generational perpetual tax shelter, that it would be limited. The tax rate likely will increase. Back in 2009, the rate was 45%. At the beginning of when I started practicing, the top rate was 55%. So a 40% rate is actually where we are now, is relatively modest for the estate tax. Another big proposal that Biden has is the loss of basis step up, and even this sort of floating the idea that we would have recognition of capital gains at death. So if your father left you stock and the basis, his basis had been very low, and the basis that as of his date of death was quite high, you would actually potentially have to recognize that capital gain. I think practically speaking, that's going to be hard to do. There was one year, 2010, the year of the estate tax repeal, where we did have a form of carryover basis. And many people don't have good records, but we'll see where that goes to. I think one thing we have to remember about, any presidential tax plan is a president doesn't make the law, Congress makes the law. But regardless of what happens in Congress, I would expect other attacks on estate planning strategies, some of which were underway under President Obama, and increased regulatory compliance, because that is something that the president does control. Next slide. So the timing, Dave talked about this a little bit. How likely is this to happen retroactive to January 1st, 2021? The issue really is, do you have to make gifts before the end of this year to lock in exemption? Because perhaps Congress meets, passes law, and makes it retroactive to January 1st, 2021. So if you don't use your exemption prior to that, you've lost it. Definitely retroactive tax laws have been found to be constitutional, so it's possible. As Dave said, the result in the Georgia special elections could result in a 50-50 Senate with the vice presidential tiebreaker. I think the likelihood, even if that were to happen, which is, as Dave said, a stretch, is hard, because the Democrats would need 60 votes to overcome a filibuster. There have been a lot of talk about what if a filibuster is eliminated, but I've heard several senators on the Democratic side already come out and say they would never vote again to get rid of the filibuster. This is post-election. I think they're worried about retaining their seats in 2022 or 2024, 2026 or 4. And what could happen, reconciliation could be used. That's where you can pass tax legislation with less than a 60 vote majority, but they can only use that 3 times a year. There's other things that the Democrats would probably want to do if they were lucky enough to get 50 votes. So we shall see. I think the political realities that we saw through the recent election also point out that the Democratic Party has, as they say, a very broad tent. I think it's going to be hard to get all those people on board with comprehensive tax reform. And I think those people that are closer to the middle of the political spectrum are going to be very worried about tax law changes, tax hikes that are going to align them with the people on the far left of the party. I think there are also practical realities that those of us dealing with the IRS know, which is it's just hard for the government to get the right forms out in time to make a tax law retroactive. So that is another difficulty, even if we could get through the political realities, the Georgia special election and all that type of thing. So what I would say is at this point, it's extremely unlikely, but it's possible. So basically what I'm saying to clients is I can't guarantee that it's not going to happen. It's a little bit like lightning could strike and it could happen, but the damage would be significant if it does. So you have to weigh all that as you're trying to determine whether you're going to move forward with planning now or pause and do a more deliberate job going into the next year or two. Next slide. So what do you do? No client should be transferring large amounts without careful, deliberate consideration. Just because a tax law is changing is not a reason to give away $11 million or $23 million. I think it's such a large exemption right now and such a big risk that half of it will be eliminated. And the shift in wealth that would go from your family to the government if that happened is very frightening for people. But I think you really need to look at, do you really want to make the transfer? Do you have cash flow concerns? And we'll get into that. The impact on the change of an exemption, would there be a clawback? That's something that has been floated ever since this issue came up in 2012, when the exemption was supposed to drop back down to $1 million. It was at 5 million then, and ultimately it ended up at 5 million plus inflation. So a lot of people in 2012 scrambled around and gave away a lot of money, and there was a lot of talk about the clawback. Meaning, if you gave away money and then the law dropped, the exemption dropped, would you somehow have to pay gift tax or have that amount clawed back into your estate and pay tax anyway? It's pretty good regulatory authority at this point that a clawback is not a concern. If you make a gift at the time that you have gift exemption and the law changes later, you should be protected. There are issues that are complicated by marital property in Wisconsin in terms of using one spouse's exemption. So if I have a couple who has 23 million in exemption, but they only want to give 10 million away, my advice would not be to have them each give 5 million away, because if the law drops then to, let's just say, a $5 million exemption, the government's position would be they each used 5 million, they each have 0. So instead, I'd want one spouse to use the full $10 million exemption. That way, when the law drops, if it goes down to 5 million, one spouse has used 10 and one spouse still has 5 remaining. But to do that in a marital property state, you've got to do probably an opt-out agreement between the spouses. You're not going to want to make a gift splitting election on the gift tax return. So there are some issues to think through on the front end of making these transfers. Considerations that every client needs to think about before deciding to think about whether they're going to make the transfer and how is a comfort level with giving assets away. And it really, I found, doesn't have a lot to do with the number of zeros. I have people who have tens of millions of dollars who are not comfortable giving even 10% of their wealth away. And I've had other people who have not a lot more than $20 million who are intent on giving a big chunk of that away. So it really is comfort level. It's cash flow needs, which have to be reviewed very carefully. And then the overall wealth transfer objectives and the planning that they've done to date. I have a lot of clients who already did significant planning in 2012. And perhaps they look over at those trusts they've established that will pass to their children and future generations free of tax and say, I've done enough already. I know I might lose some additional exemption, but I don't really want to leave more wealth to my family. I have some clients who have changed their estate plans to leave any taxable amounts to charity. In that case, there's really no rush at all to be worrying about giving more away. So just looking at that in context of what the objectives are. And I think the likelihood of additional tax changes between now and the client's death, of course, none of us know when our number is up. And this planning is a little bit like Russian roulette. You don't know what the law will be. You don't know what your date of death will be. But if I have someone in their 40s wanting to, give $23 million away, I will try to talk to them about the fact that permanent tax reform is never permanent. That's something that, having been around the block a few times, it really helps to just say, this is going to last, but it's going to change. It'll last 4 years, it'll last 8 years. If you're 40 years old, you could see many, many changes. So, and there's many tools that we have to shift wealth to future generations without tax, where we don't really need a lot of exemption. So this isn't your last chance to do some tax planning. Next slide. Possible structures include outright gifts. So you could certainly just write a check to your children, and that would effectuate a gift very simply. Very simple, but downsides to that might be that that amount's going to be in their taxable estate. So ultimately they may need to turn around, hire a lawyer and do this planning all over again. In addition, you may be concerned about creditor issues for your child, divorce. And so a lot of times the structure that is used is some form of trust. Here are on this slide a number of different trusts listed, and several of these can be the same thing all at once. So an intentionally defective grantor trust is an irrevocable trust, meaning outside your taxable estate, where you've given up control over the assets, you've named a trustee, you've named beneficiaries, but you've reserved certain powers so it is still included in your income tax base. So it's a little bit like a Venn diagram of your typical irrevocable trust, which is a separate taxpayer, and a revocable trust that you might have to avoid probate, which is just your alter ego for income tax and estate tax purposes. This type of trust is outside your taxable estate, but inside your income tax base, which really allows it to grow like a Roth IRA because you're paying the taxes out of other assets. So it's a very typical structure to this kind of planning with large gifts. Spousal access trusts are usually structured as intentionally defective grantor trusts, and that's basically just a trust where your spouse is one of the beneficiaries. You can think about it as if you have an estate plan that says on my death, the exemption amount will be funded in a family trust for the benefit of my spouse, and ultimately on the spouse's death pass to the children free of estate tax or trust for their benefit. You're just accelerating this so you can fund it with the current high exemption instead of needing to die to implement that plan. And that can give a lot more access and control to the couple of cash flow through the trust. Dynasty trusts, this is something where you would allocate not only your gift estate exemption, but also your GST exemption, also typically structured as an intentionally defective grantor trust. So you could have a dynasty trust, which is a spousal access trust during the spouse's life and is an intentionally defective grantor trust. Another type of trust we hear a lot about are grantor retained annuity trusts. Those are trusts that allow you to retain an annuity from the trust assets for a term of years. So you could give a piece of rental property away, retain an annuity equal to the rents for a 20-year term, file a gift tax return, basically present value that remainder, and it would help you leverage the use of your exemption. Charitable trusts, both lead and remainder, charitable lead trusts or charitable remainder trusts, can work very much like a grantor retained annuity trust, where you're bifurcating a trust interest between charity and between yourself or your family members. And there's ways to leverage that charitable deduction to get you some income tax benefits as well as estate tax minimization. Next slide. Important tools when we're doing this planning are valuation discounts, especially for business owners, and most of my clients are business owners. Valuation discounts are critical because they allow us to basically take the entity value of the business and slice it up into pieces, and the sum does not equal the whole. So if you have a business worth $100 million, but you have voting and non-voting shares, you might be entitled to a 30 or 40% discount for a transfer of those non-voting shares. So clearly, if I only have $23 million of exemption to use, I'm going to want to put as many interests as I can into that exempt piece. So valuation discounts are critical. Valuation discounts are something that I think may be under attack in a Biden administration. Intra-family valuation discounts were very much on the table in the Obama administration. It's important to do this planning inter vivos. That's a legal term, meaning during your life instead of at death. Because if I die owning 100% of my business or owning voting control of my business, I'm not going to get a valuation discount. Where if I make a gift during lifetime, I can take that valuation discount, which can really minimize the tax bite by millions of dollars. Another important tool right now is that some businesses are going through sort of a depressed value because of COVID. So the time to gift is when values are low, if you're lucky enough to get to choose. It's hard because emotionally, I think it's harder for clients to gift when their net worth is probably lower, but that is the best time to gift business interests. And right now we have sort of a perfect storm in terms of great reasons to do planning. Interest rate assumptions currently are at historic lows. I was looking at something I did in 2009 talking about low interest rate assumptions. And at that point, I mean, the interest rate assumption for a GRAT, for example, which would be the midterm applicable federal rate, was 2.4%. Today, it's 0.6%. So it's historically low. Short-term loans up to 3 years, I mean, the rate is like 0.17%, a little over 0.5% for a midterm rate, which is up to 9 years. And a long-term loan would be like 1.17 or 1.2% rate right now. So incredibly low. So if you're able to transfer business interests or other property that's going to grow at a rate greater than that interest rate assumption, what you can do is put those assets in one of these trusts, take back a note with that interest rate assumption. And basically the arbitrage between the interest rate and the actual growth is a tax-free gift. So we do a lot of this planning with installment notes, sales, or if you've got marketable securities or cash, you can do loans. If you do it to an intentionally defective trust, you don't even need to report the interest income because that trust is your alter ego. This type of planning also really helps with cash flow. I've had numerous clients talk to me this fall about wanting to use their exemption, but at the end of the day, we figure out they don't really have the wherewithal to give away $10 million or $20 million worth of assets. And so what they end up doing is maybe making a gift of a couple $1,000,000, but then doing a sale or a loan of the balance so that they are locking in and freezing that upside out of their estate. Next slide. Finally, planning pointers. Whenever we're drafting these trusts, we want to make sure that we have a lot of flexibility. Again, one thing I know, having been doing this for 30 years, is you never know what the law is going to be when the client passes away. So you want to have provisions in the trust that allow for some modification. These tools to add flexibility that I have listed are different things that we will talk to clients about to incorporate within the trust document so that we have a variety of ways to maneuver if the law changes, or just if the family constellation changes or something else happens that means that that irrevocable trust we created back in 2012, let's say, the client wishes we could change it. There usually are a variety of things that we can do to get the client in a position where the trust works well. So I will stop talking and leave it open for questions.
All right, Jennifer, thank you so much. There are a whole bunch of questions, but if you do still have a question to ask, submit it in the Q&A feature. So we're going to come back to you, Jennifer. I've got some that were submitted or specific for you, but Dave, Mary, if you could go back to some of the slides that Dave has regarding tax planning for businesses. I'd like to spend a couple more minutes or so on those two areas, because I know there's a lot of business owners as far as attendees go. Could you, Dave, explain, go over this a little bit more? Maybe it's the slide that if you have a tax loss in 2018 or 2020, describe a little bit more about the CARES Act. Might be the next slide, Mary, I'm not sure. The CARES Act, and then the 50 states disaster situation that President Trump.
Sure. Yeah. Well, while she's looking for that, we can talk about that. It's the slide, Barry, that says if you or your business had a loss in years 18 through 20. So what we're talking about in that area is there was a casualty loss. Say, for example, say you had a casualty loss in 2020. You can go backwards into 2018 and 2019 and apply them to your losses in those years and effectively get that money back in your pocket versus taking the casualty loss in 2020 and then filing your taxes next year, next April or August, whenever you do them, and then getting that loss. And so that's what, when President Trump declared it a disaster, he allowed those losses to go backwards, which is was very unique. Now let's separate that from the net operating losses, which is something totally different, which is if you had net operating loss carry forwards, they're carry forwards into the next years. These are losses that you can go backwards with. So that's a really interesting piece. But again, we're talking about casualty losses that you had in this year relating to COVID, for example, that you can go and apply now on 18 and 19 returns. And then you could get 18 or 19, and then you would get that, you'd have to refile your taxes, but then you would get that check versus waiting until next year to file your taxes.
And
clear as mud?
Absolutely.
Okay.
And then the disaster areas, there's a opportunity to take advantage of that as well.
Yeah, that's what we're talking about is the disaster areas, and that's what all those 50 states were part of. And so that is an important piece as well. And again, remember, this is just part of it, and we're not trying to give anyone a haircut here through the computer. You have to sit down with your tax planner and your lawyer and make sure you know exactly what you're doing. But these are discussion points to bring back to your planner and say, would this apply to my circumstance?
Great, thank you. There was a question from what the two of you know. What are the odds? You were saying odds before, the 80% versus 20% versus the Senate in Georgia. What are the odds that the projections of being the PPP being non-taxable?
It's not taxable now. So if it is forgiven, it's not taxable. What we were referring to was the expenses. If you use that and then used it, for example, to pay payroll or rent, those normally would be deductible expenses. They're not. So so that's what you have to pay attention to. So
the income from the PPP is non-taxable.
Correct.
Okay. We have a question here. We're looking at a possible sale of the company in the tens of millions of dollars in which I would get 65%. I'm looking at using a trust to minimize the tax rate. Good, bad?
That's a Jennifer question.
Well, I certainly think anybody who is looking at a potential sale of their company should be doing some estate planning beforehand. I'm not sure if because ultimately there will be some good ability to shift wealth prior to the sale into one of these irrevocable trusts. But I'm not sure if that was what the question was focused on, or if the question was focused more on income tax planning and really trusts, using a trust for income tax planning for a Wisconsin-based business is going to be pretty difficult to get any lower income tax rate.
What are for both of you? What are some of the best practices, or the biggest? Let's call it start with the biggest mistakes made. Is it that's planning on the estate planning side with trusts and things? Everybody wants to pay the lowest amount of taxes. They can't evade paying, but reduce and defer, like you said, Dave. What are some of the issues that you are finding you're addressing your clients the most?
I think that's a great question. And the biggest mistake is not planning, is not employing your teammates, your tax planner, your estate planner, your financial planner in the conversation. And then, someone comes along and says, I want to buy your company, and you haven't done the work to think about it. And I mean, now's the time to do it. You at least have the conversation. We have all kinds of examples of people who think that their kids want to take over, they want their children to take their business over, but they say, Dad, I'm not going to go and sell bananas and apples. You worked your butt off your whole life. That's not something I want to do. And so that's the planning has to happen now. And so the biggest mistake is not planning, at least in not having those conversations about how to shift ownership and think down the road. Succession planning is so key, and still not many people are doing it. And so employ the Jennifer D'Amatos of the world to make sure that the estate plan is on track and that you're having the conversation with the correct people.
Yeah, I would agree with that. And I think sometimes people just think I will do that when I retire, or I had a client 10 years ago or so come to me after he'd sold his business. He was 75 years old and worth $80 million and said, now I'm ready to do planning. Well, you've limited my tools at that point. I mean, really, you want to start early and have a very long runway to the planning so that it doesn't need to be abrupt or extreme. But I think business owners are so busy with their day-to-day and building their business that it really takes a big effort to be strategic about where is all of this going over the longer term. And am I working really hard to build the business, but not really realizing on the back end, 40% of that is going to be shared with the government because I haven't put the appropriate structures in place. So I completely agree with what Dave said.
Sure.
Jennifer, Jennifer, can I just add on to that, Dan? Yeah, so it's really, Jennifer, I'm asking this question. A lot of people have spent their entire lives building their business and their asset. Like you say, they have their nose down to the grindstone, and then they've accumulated this big asset. And now they go, what do I do with it? And some people are struggling and saying, I don't want to give my kids all of this money. How often do you have that conversation?
Yeah, I think we have that conversation a lot. And when we're drafting irrevocable trusts, even though it's not always the most tax effective way to do, we usually have some flexibility to basically turn that faucet off and divert to charity. So that if the parents think that there's just too much wealth there, and some people feel very strongly that they don't want to leave more than a certain amount to their children or grandchildren, that there's ways to divert it. But I think it's that's what's so interesting about this area of practice. Every client is different. Every client has different objectives about their legacy and what they want to do for their family versus their employees versus charity, how much they care about minimizing taxes. I mean, I think everybody wants to minimize taxes, but some people are willing to really do all kinds of complicated things to do that. And others say, the kids are going to get enough. I'm not crazy about paying taxes, but I'm okay with it.
Mm-hmm. We had some questions regarding gift to children. So what's the limit to gift to child or other person without any tax burden to the recipient?
Well, there's a couple ways to do it. I mean, there's an annual exclusion limit, which is $15,000. So you can give $15,000 to any number of people free of any gift tax, or any gift tax reporting does not use your exemption. So a married couple could give $30,000. There's also the ability to do unlimited pay direct for educational and medical expenses. So to pay for college or those types of things. And that does not use your exemption. And then there's the ability to make gifts all the way through your $11.58 million of exemption during your lifetime without paying any gift tax, though you do need to file gift tax returns if you do that.
Jennifer, one thing that we're getting asked by some of our clients is, when they want to do a 529 planning to help their kids or their grandkids, for example, you can take 5 years worth of that gift amount and bunch it into one contribution into a 529 plan, as you well know, and make a significant contribution to a 529. And then you multiply that over a number of years, 10, 15 years, and the kids will be in a much better spot.
Exactly. And there you would have to file a gift tax return to make that election, but you can basically take 5 years worth of annual exclusions and front load.
Dave, this question might be for you. I'm already balanced. I already have a balanced portfolio. Should we be looking at more advantageous strategy for keeping more of our money?
Yeah, everyone's balance is different. I mean, you can just simply take a Fidelity balanced fund and a Vanguard balanced fund and look how they are comprised, and they're significantly different. So, not all 60/40s are the same. And, the 40 represents generally the fixed income side. And if you're in long-term treasuries, for example, even though that's the fixed income, and interest rates go up as expected over a number of years, you're going to take a hit to your principal versus, bank loans or high yield bonds on the fixed income. So how your asset allocation is put together is significantly different. And on the equity side, people are very centric to what they know. Here in the United States, so many people invest in just U.S. companies and exclude international. Or we did this study that found people in California and on the West Coast invest mostly in tech. People in the South, energy. People in the Midwest are industrial, and people on the East Coast are in financial stocks. And so people are very centric. So how people's asset allocation is different. You look at where we are, the Fed has got your back. I mean, interest rates are supposed to stay low for the next several years. But we don't know if we're going to get more fiscal stimulus. We don't know how this vaccine is going to work. If what if this thing mutates and the vaccine doesn't work? And so there is so much that goes into asset allocation in being strategic of how you balance your portfolio, and as the facts and circumstance change, that you're tactical enough to make changes.
Thanks. Okay. I'm selling my company to a larger entity and I'm looking to see how to transfer the funds of the transaction. Any insights you can give this individual?
Jennifer, you want to start on that side?
I'm not really sure what the question is. I'm transferring, say that again.
Selling my company to a larger entity and I'm looking how to transfer the funds of the transaction. So yeah, I don't know if he's looking to just minimize.
Right.
Yeah.
Right. So let's assume that he's done some estate planning and tax planning, and now he's got this big bucket of money. And so what does he do with it? You know, the first thing that, again, that he needs to do or she needs to do is sit down with a planner and saying, okay, I have this bucket of money. What are my goals? What is it that I want to do? How much income can that generate for the rest of my life? And so you start with that basic planning, and then once you have that bucket of money, you can go. We use independent custodians like Charles Schwab, Fidelity, TD Ameritrade, and then you place that money in an asset in a custodian, and then you begin to build your portfolio. So I would not rush and do anything. I would take a very strategic and long-term plan on how to put that asset to work and make sure it aligns with what you're trying to do. If you have debt, if you want to gift some money, if you want to give it to your church, your school, whatever, that is all part of the planning that the whole team needs to be sit down with.
Great, thanks. What are the chances of the lifetime exemption changing? You might have addressed this, but I can't recall.
Yeah, I mean, I think that really is a lot of what I talked about. I think it is going to change in January 1st, 2026, and may well change sooner, probably not January 1st, 2021. Maybe later in the year. And then, you know, I think every time we have congressional elections, there's additional risk if the Democrats don't control this go round that they could 2 years from now.
And let me just add, Jennifer, you know, all of this, as you say, that sunsets in 2026. So no matter what, you've got a window here, you know, for the next 5 years to do some planning, because all the politicians have to do is nothing, which they're good at, and the taxes then go up in 2026. So there's a window here that people should certainly take advantage of, both on income and estate planning taxes.
Jennifer, question, can you give us an example of coupling charitable legacy objectives with good tax planning? So I know this is a big issue for a lot of high net worth individuals.
Sure. I have, as I mentioned before, several clients who have estate plans who leave a lot to charity at death for a variety of reasons. They're charitable, or they just don't want to leave any more to their children, whatever it may be. Sometimes to a family foundation, sometimes to a donor advised fund, which Dave also mentioned. I had a client recently who had an estate plan that left $20 million to charity at the second death. And we decided that it would make sense to do a charitable remainder trust where the husband and wife retained a 6% annuity. So they got $1.2 million back every year, or will. They will get, charity will end up with the balance. So if the portfolio earns 6%, charity will get 20 million because the 6% will come off to them. And they get an upfront income tax deduction of about $5 million. They're in their 60s, so they'll have that 1.2 million or so, 6% of whatever that portfolio is every year until death. And then that amount will pass to charity. And instead of just leaving the plan as it was, where they wouldn't have paid estate tax, but they didn't get the income tax deduction, we basically were able to get them a $5 million income tax deduction that they'll be able to use this year, and then the next 5 years.
One more thing, Dan, to that is, you know, and I know that Jennifer is talking about people have 20 million, but we have people who don't have 20 million, and there's a couple of ways to do that. I mean, a lot of these tech stocks, for example, have gone up significantly. And if you want to make a gift, you could take a highly appreciated asset, instead of selling it and paying the capital gains and then making setting it to the philanthropy, is send the shares to the 501c3. The charity can then sell it and avoid the capital gain tax, and you get the entire gift, not the tax reduced gift. That's one. So gifting highly appreciated assets. And the second is, inside your IRA, you have to take a required minimum distribution, you know, 70 and a half, and then going to 72. is you could take your RMD and give it right to the charity and not take it as income and get the full tax deduction. It's called a QCD. And so there's a lot of benefits that are out there, even for the people who aren't in a position to set up a charitable event. You know, you can do some planning with daily money.
Yeah, that's so important. That's a great point. Or just a couple more questions because our time is up and we're just going to go a little bit beyond 2 o'clock because this is just great stuff. So Jennifer, and I'm sure Dave, you might have some insights here. What should clients do if they have less than 23 million, assuming that they're a married couple, but more than 10 million or so in our current environment and looking forward?
Yeah, I think that's a great question. You know, for people that have over 23 million, it's pretty easy for me to say, you know, you've got issues now, you're gonna have bigger issues if the law changes. You should start doing some planning and get serious about it. And for people under 10 million, you know, or maybe I'd have to say under 7 million, they probably don't have issues, but it's those people in between where right now they don't have estate tax issues. And if they hold the assets to death, they'll get a step up in basis. So the kids will be better off than getting a gift perhaps. That it really is going to depend on the client's age. I mean, if someone is in their 40s or 50s, I'm probably going to say I would hold tight and start doing the annual exclusion giving, maybe doing some gifting, but I certainly wouldn't be looking at giving away $10 million. But if I have clients who are in their 80s and it looks like the law is going to change and they may not be around for another change in the tax law, I think there you have to think long and hard about whether you might make a large gift and forego what they would get if they died now, which is the step up in basis. But those are the most difficult clients to counsel, I think. It really depends on the circumstance.
Let me just, and if I can, just on top of that, Dan, you know, even though they may not be there today, say, you know, we're talking about someone who's got $7 million, but whatever their business is, you know, they're likely going to sell more widgets, whatever they are, hamburgers or equipment or whatever it is. And those widgets, you sell more of them, the value of your corporation is going to go up if you put a multiple on EBITDA. So even though you're not there today, that 7 million could be over 20 million down the road, given some growth. And at the same time, there could be a likely reduction of the estate tax limit. So the combination of those things, even though you're at that level now, doesn't mean that you shouldn't consider it, because you have to give yourself room for growth, assuming that you're gonna grow that asset.
Okay, very insightful. Jennifer, do you have any last comment?
No, I don't think so.
For everybody, Dave, and you know, maybe just one last question for you and Jennifer. I mean, how does one go about selecting advisory firm? How does one go about selecting counsel? You know, that, you know, I don't have a plan. You know, how do I, you know, there are a lot of good companies out there. How do I compare and contrast? What should they look for?
Jennifer, you can start with that.
I would say talk to a lot of people that you trust. Usually when I get a new client, they've heard about me from a variety of sources, you know, their accountant, their financial advisor, their neighbor. Talk to a lot of people. Be willing to interview, you know, several people. It's really important. And it's not only the, you know, the academic requirements and the experience, it's whether you have a good connection with that person. So I think it takes a little homework to make sure you end up with, you know, with the right advisors.
Good point. Yeah, and I'd add on to that, you know, Dan, as you well know, we spend a lot of time delivering the message of know the difference. And what we're talking about there is that there's a difference in financial advisors between those who are brokerage, you know, suitability standard folks who are in the business of selling versus those who are in the business of getting paid for advice. And that's really a fee-only fiduciary. That's a key term. So finding a fee-only fiduciary, and of course lawyers are fiduciaries, is that is where I would start and ask questions about who am I going to deal with, who's my team, who's on the team, do they have, what's their history? You know, you can go to SEC's website and look an advisor up. You can go to FINRA.org org and look an advisor up if you're trying to choose a brokerage firm versus a financial advisor. I mean, there's several places you can go: banks, brokerage firms, insurance agents, and fee-only fiduciaries. Obviously, we're in that last sleeve, and we think that's the best model. I'm not trying to turn this into a commercial, but ask questions, get referrals, and do your homework before you make a choice.
Great. On that note, we'll end it. I know there are questions that we didn't get to, but both Jennifer and Dave said that they would get back to those folks that didn't have their questions answered. So thank you again to Dave Spano, President and CEO of Annex Wealth Management, and Jennifer D'Amato, shareholder with Reinhardt, Berner Van Duren. So these are the experts. You'll find their contact information on this slide. If you have any questions, they welcome your call and welcome the opportunity to talk to you. They're happy to help you regarding the issues related to our topic, wealth transfer and safeguarding your assets in a shifting estate and income tax landscape. As I mentioned earlier, the webcast recording will be available on our website, certainly by tomorrow and maybe even later today. And the slide deck is available online now. So when you exit the webcast, the new tab will open your browser with a survey. So please fill out the survey where you can then access the slide deck. We certainly value your feedback as we look to have more webcasts like this in the future. So on behalf of our webcast presenters and partners, Annex Wealth Management and Reinhardt, Berner Van Duren and BT360 Content Solutions, the storytelling arm of BizTimes Media, thanks again for attending and have a great rest of the day, everybody. Thanks, Jennifer. Thanks, Dave.
All right, thank you.